If you're a complete beginner and the stock market feels confusing, intimidating, or maybe even a little risky, this video is for you. Because in 2026, learning how to invest is no longer optional if you want to build real wealth over time. Inflation still eats away at cash, savings accounts often lag behind long-term market returns, and waiting too long to start investing can cost you years of compounding. So in this video, I'm going to break down exactly how the stock market works, how beginners should start, what mistakes to avoid, and how to build a simple investing strategy that actually makes sense. Let's start with the most basic question. What is the stock market? The stock market is a place where investors buy and sell ownership in companies. When you buy a stock, you're buying a small piece of a business. If that business grows, becomes more profitable, and investors believe in its future, the value of that stock can go up. Some companies also pay dividends, which means they share part of their profits with shareholders. That sounds simple, but here's where beginners get lost. Most people think investing is about finding the next big stock that's going to double overnight. In reality, long-term investing is usually much less exciting, and that's actually a good thing. The people who build wealth are usually not the ones chasing hype. They're the ones investing consistently, staying patient, and letting time do the heavy lifting. Now in 2026, beginners have more tools than ever before. You can open a brokerage account in minutes, buy index funds with almost no fees, automate your contributions, and track everything from your phone. But even though access is easier, success still comes down to the basics. So here's the first rule. Before you invest, make sure your financial foundation is solid. That means paying off high-interest debt first, especially credit card debt. If you're paying 20% interest on debt while hoping to earn 8% or 10% in the market, the math is working against you. It also means having an emergency fund, ideally 3 to 6 months of living expenses, so you don't have to sell investments during a bad market just because life happens. Once that's handled, the next step is opening the right kind of account. If your country offers tax-advantaged accounts, start there. These might include retirement accounts, tax-sheltered investing accounts, or employer-sponsored plans. The reason is simple. Taxes matter, and reducing taxes can significantly improve your returns over time. If you've already maxed those out, then a regular brokerage account is your next option. Now let's talk about what to actually buy. For most beginners, the best choice is not picking individual stocks. It's buying broad index funds or ETFs. An index fund is a collection of many stocks bundled together. Instead of betting on one company, you're investing in a large group of companies all at once. That means more diversification and less risk compared to putting all your money into a single stock. For example, a total market index fund gives you exposure to a huge portion of the stock market. An S&P 500 index fund gives you exposure to 500 of the largest US companies. There are also international funds, bond funds, and dividend-focused funds. But if you're just starting, keeping it simple is usually the smartest move. A very common beginner mistake is overcomplicating the portfolio. You do not need 17 ETFs, 23 stocks, and a spreadsheet that looks like a NASA launch plan. In many cases, 1 to 3 well-chosen low-cost index funds are more than enough. Now let's talk about risk. The stock market goes up and down. That is normal. A 10% correction is normal. A bear market is normal. Volatility is not a sign that investing is broken. It's part of the process. The mistake beginners make is they invest when the market feels safe, then panic and sell when the market drops. That's backwards. Successful investors understand that short-term declines are the price you pay for long-term growth. This is why time horizon matters. Money you need next month should not be in the stock market. Money you won't need for 10, 20, or 30 years is where stocks make much more sense. The longer your timeline, the more powerful compounding becomes. Compounding is where your returns begin earning returns. Then those returns earn more returns. Over long periods of time, this effect can become massive. That's why starting early matters so much. Even small amounts invested consistently can grow into something meaningful over decades. And that brings us to one of the most important habits for beginners, dollar cost averaging. This simply means investing a fixed amount of money on a regular schedule, regardless of whether the market is up or down. Maybe that's every week, every 2 weeks, or every month. This removes emotion from the process. You stop trying to time the market and instead build the habit of steady investing. Because the truth is, most people cannot consistently predict where the market will go next. Professionals struggle with that. Beginners definitely shouldn't build their strategy around it. Another mistake to avoid in 2026 is getting pulled into social media investing hype. Every market cycle has its hot trend, AI stocks, meme stocks, options trading, crypto-adjacent plays, or whatever people are suddenly calling the opportunity of a lifetime. Some of these may do well, many will not. But if you are a beginner, your focus should be on survival, consistency, and education, not gambling disguised as investing. Here's a simple beginner framework. First, build your emergency fund. Second, pay off high-interest debt. Third, open a tax-advantaged or brokerage account. Fourth, invest automatically into low-cost index funds. Fifth, ignore short-term noise and stay invested. If I had to explain the stock market to a beginner in the simplest way possible, I'd say this. The stock market is one of the most powerful tools ever created for building long-term wealth, but only if you understand the rules before you start playing the game. And that's what this video is about, because in 2026, there's a weird problem. It has never been easier to invest, but it has also never been easier to invest badly. You can buy stocks instantly, follow random influencers, copy risky trades, and lose money faster than ever, all while thinking you're being financially smart. So let's fix that. The first thing you need to understand is the difference between investing and speculating. Investing means putting money into assets that can grow in value over time based on real business performance, earnings, and long-term economic growth. Speculating is when you're mostly hoping someone else will pay more for the asset later, often without any solid fundamentals behind it. Beginners confuse these two all the time. Buying a diversified index fund and holding it for 20 years is investing. Throwing money into a stock because it's trending online and everyone says it's going to moon is speculation. Now, that doesn't mean you can never take risks. It just means if you're building your financial future, the core of your strategy should not depend on hype. So where should beginners start? Start by understanding what you're buying. When you buy a stock, you are buying a share of a company. If the company performs well, earns more money, grows its profits, and becomes more valuable, your shares may increase in value too. If the company struggles, your investment may go down. That's why owning just one or two stocks can be risky. If those companies do badly, your portfolio gets hit hard. That's why diversification matters. Diversification means spreading your money across many investments so that one bad outcome doesn't destroy your progress. This is where ETFs and index funds become incredibly useful. An ETF, or exchange-traded fund, is basically a basket of investments. Instead of buying one company, you can buy a fund that holds hundreds of companies. For beginners, this is often the easiest and safest way to get exposure to the stock market without having to become a full-time analyst. A great beginner question is, should I buy individual stocks or index funds? For most people, index funds win. Why? Because they're simple, diversified, low-cost, and historically effective over long periods of time. Could you outperform the market by picking great stocks? Maybe. But can you do it consistently for decades after fees, taxes, mistakes, and emotions? That's much harder than people think. Another big concept beginners need to understand is volatility. Volatility means prices move up and down. And in the stock market, they absolutely will. Some days your account will be green, some days it will be red, sometimes the market will drop for weeks or months. That does not automatically mean something is wrong. It means you are participating in a real market. The reason people fail isn't usually because they picked a terrible fund, it's because they let their emotions take control. They get excited when prices rise and scared when prices fall. They buy after things have already gone up and sell after things have already gone down. That's why discipline beats intelligence in investing. You don't need to be the smartest person in the room. You need to be the person who sticks to the plan, and one of the best plans for beginners is automatic investing. Pick a fixed amount. Invest it every month. Keep doing it whether the market is high, low, boring, or scary. This strategy works because it removes the need to predict the future. You are no longer trying to outsmart the market. You are building consistency. Now let's talk about portfolio structure. A simple beginner portfolio in 2026 might include a broad US stock market fund, an international stock fund, and possibly a bond fund depending on your age and risk tolerance. Younger investors with long time horizons often lean more heavily towards stocks because they have more time to recover from downturns. Investors closer to retirement may prefer a more balanced mix with bonds for stability. The key is choosing an allocation that lets you sleep at night, because the best portfolio is not the one that looks the smartest on paper. It's the one you can actually hold through a market crash without panicking and selling everything. Now, here are some mistakes beginners should avoid. Number one, trying to get rich quickly. The stock market is a long-term game. If your expectations are unrealistic, you'll constantly chase shortcuts. Number two, investing money you'll need soon. The stock market is not the place for next month's rent, emergency cash, or money for short-term bills. Number three, ignoring fees. High fees quietly destroy returns over time. Low-cost funds matter more than most beginners realize. Number four, checking your portfolio every 5 minutes. If you stare at daily movements, you'll feel every emotional swing. That leads to bad decisions. Number five, copying strangers online without understanding the risk. Just because someone sounds confident doesn't mean they know what they're doing. And finally, number six, waiting for the perfect time to start. There is no perfect time. There is only time in the market versus time spent hesitating. If you're wondering how much money you need to begin, the answer is probably less than you think. You do not need thousands of dollars to get started. Many brokerages now allow fractional investing, which means you can begin with a small amount and still build momentum. And that's the mindset shift beginners need in 2026. Stop thinking of investing as something rich people do after they already have money. Think of it as one of the ways regular people slowly build wealth. The goal is not to impress anyone with your stock picks. The goal is financial freedom, flexibility, and options in the future. So here's the beginner blueprint. Learn the basics. Set up your emergency fund. Open the right account. Buy diversified low-cost funds. Automate your investments. Stay patient, ignore noise, repeat for years. That may not sound exciting, but that's exactly why it works. Because successful investing is usually not about doing more, it's about doing less, but doing it consistently, intelligently, and for a very long time. So if you're a beginner watching this in 2026, don't worry about being late. Don't worry about not knowing everything. You do not need a perfect strategy to begin. You just need a sound one. And if you can build that habit today, your future self will thank you for it. That's it. You do not need to become an expert overnight. You do not need to read every earnings report. You do not need to predict recessions, interest rates, or election cycles. What you need is a system that is simple enough to follow and boring enough to repeat. Because wealth is rarely built through one perfect decision. It's usually built through many reasonable decisions repeated over a long time. So if you're a beginner in 2026, this is your reminder. Start before you feel ready. Start small if you need to. Start simple if you need to. But start. Because the biggest mistake in investing is not choosing the wrong ETF. It's waiting year after year while doing nothing at all. And if you can learn the basics, stay disciplined, and give your investments time to grow, you'll already be ahead of most people. That's the ultimate guide. Not hype, not shortcuts, not overnight success, just smart decisions, consistency, and patience. Let's be honest, for beginners, the stock market can feel like a giant confusing machine built to make regular people feel late, underqualified, and overwhelmed. You hear terms like ETFs, index funds, dividends, market caps, earnings, volatility, rate cuts, corrections, and suddenly it sounds like you need a finance degree just to invest your first $100, but the truth is, you don't. In 2026, the biggest advantage you can have as a beginner is not secret knowledge, it's clarity. If you understand a few basic principles and follow them consistently, you can avoid most of the mistakes that ruin people's progress. So in this video, I want to give you a complete beginner roadmap. Not just what the stock market is, but how to actually start investing in a practical, realistic way. First, understand what the stock market really represents. It is not just numbers moving on a screen, it is ownership in businesses. When you buy shares, you are participating in companies that make products, provide services, employ people, and generate profits. Over time, many of these companies grow, and that growth can be reflected in their stock prices. That's why the stock market has historically been one of the strongest long-term wealth-building tools available. Not because it always goes up in the short term, but because productive businesses tend to create value over long periods of time. Now, here's the first beginner mindset shift. Investing is not about being right next week. It's about being disciplined for years. This matters because most beginners enter the market with a short-term mindset. They want fast gains. They want reassurance. They want every purchase to go up immediately. But real investing doesn't work like that. Sometimes you will buy and the market will drop. Sometimes it will go sideways for months. Sometimes headlines will make everything feel uncertain. That is normal. If you want certainty, the stock market will frustrate you. If you want long-term growth and can tolerate short-term uncertainty, then it can be incredibly powerful. So what should a beginner do first? Step one is not buying stocks. Step one is preparing your finances. Make sure you have a basic emergency fund. If your job situation is unstable or your expenses are unpredictable, build more cash first. If you have high-interest debt, especially credit card debt, prioritize eliminating that. Investing while carrying toxic debt is like trying to fill a bucket that has a hole in the bottom. Step two is choosing the right account. If you have access to tax-advantaged retirement or investing accounts, those are usually the best place to start. Why? Because taxes reduce returns, and protecting more of your gains over time can make a major difference. If those options are unavailable or already maxed out, then a regular brokerage account works too. Step 3 is choosing your actual investments. This is where many beginners get stuck because they assume they need to analyze companies, read charts, and predict trends. But for most people, the smartest approach is much simpler. Buy diversified, low-cost index funds. Why index funds? Because they allow you to own a large slice of the market in one investment. You don't need to guess which single company will win. You own many companies at once. That spreads out risk and saves you from the pressure of stock picking. Think of it this way. If one company fails, your entire future doesn't depend on it. That's the power of diversification. A beginner-friendly approach might be one broad market fund, one international fund, and depending on your situation, maybe a bond fund for stability. That's enough for many people. You are not building a hedge fund, you are building a long-term wealth machine. Now let's talk about one of the most underrated skills in investing, emotional control. The market does not test your intelligence as much as it tests your behavior. Can you keep investing when headlines are negative? Can you avoid panic selling during a correction? Can you resist the urge to chase whatever is trending online? Because in 2026, noise is everywhere. Financial content is faster, louder, and more addictive than ever. One person says AI stocks will dominate. Another says a crash is coming. Someone else claims they turned a small account into a fortune in 6 months. And all of it creates pressure. But beginner investors need to remember something very important. Attention-grabbing content is not always wealth-building advice. Good investing is usually repetitive. It's scheduled. It's systematic. It often feels boring. And boring is okay. This is why automation is such a powerful tool. Set a contribution amount and invest on a regular schedule. Every paycheck, every month, whatever works for you. This turns investing into a habit rather than a decision you keep rethinking. Over time, that habit matters more than almost everything else. Now let's address the question everyone asks. When is the best time to invest? The honest answer is that if you're investing for the long term, the best time is when you are financially ready and able to stay invested. Not when the news feels optimistic, not when everyone online agrees, and not after the market has already gone up and made you feel safe. Trying to time the market is one of the biggest traps for beginners. People wait for the perfect entry, and while they're waiting, months or years go by. Meanwhile, compounding doesn't care about your hesitation, and compounding is the real secret here. It's not just that your money grows, it's that the growth itself begins growing. That's what creates acceleration over time. But compounding needs one thing above all else: time. The earlier you start, the more powerful it becomes. Even if you start small, you are building something. The amount matters, but the habit matters first. So here is the ultimate beginner guide in one simple framework. Get your finances stable, build your emergency cushion. Eliminate high-interest debt, open the right investment account, buy diversified low-cost funds, automate contributions, ignore noise, stay invested long enough for compounding to work. That's it. Not flashy, not complicated, not built for internet clout, built for actual results. If you're starting in 2026, you are not too late. Markets will keep changing, headlines will keep changing, technology will keep changing, but the core principles of investing remain surprisingly consistent. Own productive assets, diversify, keep costs low, control your emotions, think long-term. If you can do that, you don't need to predict every move in the market. You just need to participate wisely and consistently. And in the end, that's what beginner investing should be about. Not trying to look like an expert, but becoming someone who makes smart financial decisions year after year. That's how wealth is really built.